Hello and welcome to our Retirement Wealth Strategies webinar series. I'll be your host and moderator for the day. I am Nicholas Scarcella, Vice President of RWS. Today we'll be focusing on the market and economic overview. As you see here with this fun image, that's a bull and a bear on a roller coaster ride, and it sure seems like we've been on a roller coaster ride. And we're excited to have our presentation from one of our trusted partners, Advisors Capital Management, here with us today. But first, before I welcome our presenter, I'd love to share with a few headlines from the media outlets that many of us see and can sometimes focus on, which most will be addressed today through the content we share. And at RWS, it's our responsibility to align our clients' goals with their assets and their income, build that financial plan, that tax plan, that estate plan that works for our clients over their lifetime. So we want you to stay invested through challenging times and find those opportunities, of course, as well through your financial plan. So what are these headlines? 1 trillion conundrum. The U.S. government mounting debt bill. The U.S. avoided a recession in 2023. What's the outlook for 2024? Here's what experts are predicting. The election, that's always on our mind. Does it really impact the stock market or not? What to expect from the Magnificent Seven in 2024? More gains from AI or artificial intelligence is what experts say. And the Magnificent Seven is referring to Microsoft, Amazon, Meta, Apple, and Google, NVIDIA, and Tesla. AI stock. AI in the stock market. How are interest rates impacting stock prices? A look at what's in the $95 billion foreign aid package passed by the House. Disappointing March inflation numbers cause a dip in the stock market. Inflation's surge has put off rate cuts, hurt stocks. Will it slow? Will it still slow in 2024? I believe this is the last one here. Find growth. Strategist tells investors not to worry about high stock valuations. So with that, I'd like to welcome our presenter, Dr. Chuck Lieberman. Everything I'm about to share about Dr. Chuck Lieberman means he's incredibly qualified and we're in for a treat. Dr. Charles Lieberman is the Chief Investment Officer and co-founder of Advisors Capital Management. He began his professional career as an academic at the University of Maryland and Northwestern University. After 5 years in academia, he joined the Federal Reserve Bank of New York as the head of its monetary analysis staff before coming to Wall Street. After years of experience in the financial services industry, Chuck co-founded the investment company Advisors Capital Management. Chuck frequently appears on Bloomberg, CNBC, and is frequently quoted in Barron's and the Wall Street Journal. Chuck earned his bachelor's in economics at MIT and his PhD in economics from the University of Pennsylvania. And now with that, we welcome you, Chuck, and thank you for joining us.
Thanks very much, Nico. The slides you showed should be easy to cover in about 3 or 4 days. But I'm going to try to do it in 20 to 30 minutes. So we're going to have to blast through some of these things. The big issue of the day is inflation. I think you control the slides. So if you could go to the next one, that's the issue. And as you can see, there was a surge in inflation. It's come down a lot, but it's since flattened out. And that's kind of what we've been expecting. We've been expecting the economy to continue to hold up better than expected. The view that the economy was headed to recession was nonsensical. It was not well founded. It was more people looking for PR and the media trying to be flamboyant than soundly based. But the real question is, how does inflation come down when the U.S. labor market is very tight and the economy is growing as quickly as it is? And that's the hard part. I just don't see it happening. Let's move on to the next one. So here's a good example of what's going on. This is the CPI for cars. And as you can see, the surge, the decline, and now it's flattened out. Let's move on. These are regional changes and rent, and again the same kind of thing. A surge, decline, and now it's actually rising a bit. again, same story. This one is more useful, shall we say, because dining out is a service. And during the pandemic, obviously that stopped. But as people have returned to normal, and we're pretty much back to normal now, you can see that food away from home is still inflating faster. And everyone, I'm sure, on this call has experienced that. When you go out to restaurants, the prices have not come down. They're not going to come down. What we're really dealing with is the pace of increase. That has moderated, but it has not gone to the Fed's 2% target level. And here's the underlying problem, right? It's the unemployment rate. The labor market is tight. We give you lots of data going back 50 years, and you can see it is about as low as it has been during that entire period of time. And this requires some very, very complex economics, supply and demand. When something becomes scarce, its price tends to go up. And that's exactly what we're seeing. The unemployment rate is low, labor is scarce, and so labor costs are rising at a pretty good clip. And that means that the cost of producing both goods and services is also rising at a pretty good clip. And so there's really very limited prospect for further reductions in the inflation rate. Job creation has been strong. This one has actually been a surprise to us, and I think most people. A year ago, if you'd asked, I would have suggested that economic growth was going to remain intact, but the pace would slow. And the reason the pace would slow was because we literally were running out of people to hire. And so I expected a slowdown in economic growth in 24, and I expected upward pressure on wage inflation because of that tight labor market. What has happened instead is that the open borders have enabled lots of immigrants to come into the country. And the ballpark estimate is a couple of million people. And that's just within the past 12 months. And so ballpark 2/3 of the people coming into the country are working age, looking for jobs. The jobs are there, and so they've been hired. And that's why employment has been so solid. We've seen job gains on a monthly basis that average comfortably over 200,000. And that keeps the economy rolling. It keeps the expansion rolling. It keeps the labor market tight. As fast as these people come in over the border, they are getting hired. And so the unemployment rate is staying at low levels. This is another way to see the same thing. Job openings are high. They've come down, so we don't have the surge that we had during the pandemic or immediately after the pandemic. But nonetheless, again, demand is strong, and that's why the hiring is taking place. Quits also have been interesting. So there was a surge in quits early in the recovery. Firms were so desperate to hire that they paid up to get workers. And that meant those who were unemployed could find jobs more readily. But it also meant that the best place to get workers for your company is from your competitors, because they know your industry, they know your business, they may be doing the same job. And so people were paying up to get their competitors' workers to quit and join them. At least that part of the story has normalized. And here's where the rubber meets the road. So this is average hourly earnings of all employees. You can see a couple of spikes, one up, one down. That's because this is the average hourly earnings. So during the pandemic, lower wage workers lost their jobs. Those are the people who work in restaurants, they work in stores and retail, they work in amusement parks. Those kind of operations literally shut down, and therefore the average wage of all people who were still employed rose very, very sharply. And then once the pandemic ended and workers were rehired, you had exactly the mirror image. More lower wage workers were hired, and that brought the average down. And both of those spikes are now behind us. And so you're getting a better sense of the underlying trend. And as you can see, we're settling in slightly north of 4%. And that's why it's very tough for inflation to come down to 2, because the difference between this and wage and overall inflation is productivity. And productivity in the US runs about 1% at an annual rate. So in rough terms, I'm making things simple. I'm getting away from some of the complexities. But in ballpark terms, wages are running 4, productivity is running 1. That means prices on average would run about 3, and that's well above the Fed's target. And that's a direct reflection of that tight labor market. So wages tend to have more inertia than prices. You can see that during the pandemic, prices dropped, then they rose sharply, then they've come down, but wages have held up with the story, the nuance of the spike during the pandemic to the upside, then the reversal spike, and the settling down at around 4%. Okay, this is an example of the media trying to scare the living daylights out of you. Credit card debt has now exceeded $1 trillion. And when that happened several months ago, there were articles all over the media. And it suggested that consumers were in trouble, were likely to have to cut back spending, and the economy was going to go into recession. And that was a false story designed to garner page views and get people to watch TV and so on. Let's look at the truth. Well, this is another one supporting that same thesis. Keep going. This is the truth. So while the absolute amount of household debt has gone up, household debt relative to income has been coming down. So people are better able to service their debt today than 20 years ago by a significant margin. Household finances are in very good shape, and this was never a reason to think that the economy might lapse into recession. One issue out there is mortgage rates. And as you can see, mortgage rates have come up pretty sharply. Interest rates were artificially low for quite a long time, and they trended lower for even longer. But things had to normalize. They did. And that carried the 30-year mortgage rate up very sharply. Even today, it's over 7%. And the thinking on the part of a lot of people was this ultimately, again, had to cause a recession. And we disagreed. And let's see if we can figure out why we disagreed. Nope. Let's go to the next one. This helps. So again, another headwind for the housing market is the price. So not only is the mortgage rate higher, but the price of homes is higher, and both of those factors work against buyers. You've got to put up more money and pay more on a monthly basis in order to buy a home. But one more, Nico. There we go. Okay, so here are housing starts. And looking at the last couple of years, you can see the impact of the rise in mortgage rates on housing construction. There's a big drop from roughly 1.7 million to roughly 1.3 million. And that directly reflects the rise in mortgage rates and home prices. But what's really interesting is that it's game over. There has been no further decline in housing construction, even though mortgage rates have set a new high. And unfortunately, there's a lengthy explanation. It goes back to 2004, 5, and 6. So look at the data for housing construction back then, and you can see that we exceeded 2 million units at an annual rate. That was a very strong level of new construction. In fact, it was so strong that it exceeded growth in population. Our population needed ballpark 1.6 million, 1.7 million at the outside, and yet we were building more than 2 million units at an annual rate. So what happened to all of those units, and why were so many units constructed? Well, back then, one of the games people were playing was to buy units and flip them. There was a lot of housing flipping going on to make money on flipping houses. And for a while it worked. And as long as people were willing to buy more homes just to flip them, not to live in them, just to buy them, raise the price, put some paint on them, and turn around and try to sell them for more money, that raised demand for new construction artificially. The builders, of course, were happy to build them, and they did. And what it did was it oversupplied the market. And housing became just like the game of old maid, where there were more houses than we had households. And so housing prices started to come down, and that created a crash in housing activity. And you can see that's precisely what happened. So the country was oversupplied, and the only way to fix the oversupply was to wait for population growth to absorb the excess and not build more. And so the rate of construction dropped by more than 75%. And that fixed the problem. But it created a new problem. I did say that we needed ballpark of 1.5 million to 1.7 million construction per year. And we've been so far below that for so long that our housing shortage of the mid-2000s, 2004, 2005, 2007, that has gone, and now we have a housing shortage. So the housing surplus morphed into a shortage. And that shortage, it's what is now propping up demand for housing. So in the latest GDP reports, which we just got, housing activity rose at a 13% annual rate, and that's despite the high level of mortgages. So again, a couple of important takeaways. One is housing is not likely to cause a recession despite the high level of mortgage rates. Two, it's going to take a while to fix the housing shortage problem. The ballpark estimate that I've come up with is about 1.5 million. One of the CEOs of a housing home builder, the guy who runs DR Horton, who was on TV just a couple of days ago, he said that the housing shortage in the US is around 4 million. I think he's smoking something. If we actually had a 4 million shortfall in housing, you would see home prices rising probably on a daily basis. So I think the right number is in the area of 1.5 million, but that's a very, very big number when you're only building around 1.5 million. So you need to temporarily, like for 2 years, run 50% above 1.5 million to make up for that shortfall. And that's not going to happen. So I see housing prices under upward pressure for some years to come. The Fed is slowly, let's go back. Yeah, the Fed is slowly drawing down its provision of reserves to the financial system. So again, things are returning to normal. Go to the next one. Interest rates have normalized. You can see across the curve. The curve is actually slightly inverted. So you get less if you lend for longer, and that's unusual. That's not typical. More normally, you get higher rates, higher interest rates when you lend for longer. A lot of people are stashing cash in money funds. They get better rates than they can from their checking account or their bank account. So this is still going on. And the market is recalibrating. So at the beginning of this year, the market was actually priced for 7 1/4 point reductions in Fed interest rates, Fed policy rates. We're now down to about 1 to 2. So this chart shows that by the end of the year, 33% call it, expect the funds rate to be between 5 and 5 1/4, and a third expected to be between 4 3/4 and 5. So most people expect 1 to 2 rate reductions between now and the end of the year. And we are in that column to the right. We think that the Fed is going to leave policy unchanged, at least insofar as current inflation, current growth are concerned. Those numbers are still a bit too strong, and so the market will have to slightly further adjust to recognize that it isn't overly likely that the Fed is going to cut rates, not without inflation coming down some more. So this is where we were asking the question before, 3 versus 6. The market was priced for 6 to 7. The Fed was priced for 3. Well, the market is now priced for 1 to 2, and the Fed is from Missouri. They're saying to the market they need to see evidence that inflation is coming down for them to be able to cut rates. So not even 2 and 2. In the meantime, the outlook for the market has improved. Not only have stocks done better, but stock earnings expectations have increased. And that's been particularly true over the last couple of weeks as we've been getting earnings reports for the first quarter. They're coming in better than expected, pretty much across the board. Like 80% of all the companies have beaten earnings expectations. And analysts are now being forced to revise upward their estimates for corporate profitability for the balance of the year. And that brings us to a valuation methodology that we've used. So this is to try to help provide a sense of how expensive the stock market is. So the first column focuses on the year 2000. The S&P was around 1,500. The price earnings multiple for the S&P was around 25. The dividend yield on the S&P was about 1.4%, and the 10-year Treasury was yielding 6.2%. That spread, the difference between the dividend yield on stocks and the interest rate on Treasuries, that's 4.8%. So to justify buying stocks instead of Treasuries, you had to expect at least 4.8% to break even, and really more than that, because as that first slide shows, the stock market is a roller coaster. And so you need to earn more in stocks compared to safe Treasuries. And so without a doubt, between a high PE multiple of 25 and a low spread to Treasuries on the yield, the stock market was expensive. And in fact, it did have a lousy 3 years after March of 2000. Now let's go to 2007. We know the stock market went down after that. It started off at around 1,500, but the PE was only 15. The dividend yield was 1.9, 10-year treasuries only 4.7. So the spread is now only 2.8. So in my judgment, at that level, stocks were not expensive. It went down because we had a credit crisis. That's what crushed the stock market. And it went down about 40%. So we're not talking about a small decline. We're talking about a massive decline. And yet, on a valuation basis, stocks were not expensive. We did have a severe recession, and that hurt the stock market. But of course, it then rebounded pretty strongly. Now let's look at it in 2020. That is prior to the pandemic. The pandemic broke in in February of 2020. So this is right before everything shut down. The PE multiple was midway between 2007 and 2000. The dividend yield was still 1.9, but look at where the 10-year treasury was, 1.6. So to think that the market was going to pay you negative 30 basis points on average per year for 10 years, that's what you would have had to believe to think that 10-year treasuries at 1.6 were more attractive or as attractive as stocks. Obviously, that was never likely. Stocks were certainly going to do a lot better than that. And so the stock market in February of 2020 was very cheap. It sank for a month and then rebounded very sharply. And that rebound made perfectly good sense. Here we are, March 31st of 2024. Stock market is higher still, over 5,000, around 5,000. PE multiple about 21, so not too far off from where we were 2020. But the dividend yield is lower, 1.4, and the 10-year treasury is now higher, actually closer to 5% today than 4.2. So that means that you've got to think that stocks will give you a return of at least 3.6% on average to break even. And that is very doable. Historically, the market has done more than that. So it's nowhere near as cheap as it was in 2020. And on this graph, it's about where it was in October of 2007. With the kind of economic outlook that we have of solid economic growth continuing, I think stocks are okay. And I'm still a little cautious about the bond market, especially long-term bonds, because from a long-term bond perspective, yields are not that high. Before all kinds of things happened back in 2000, 10-year treasuries were yielding a lot more than 4.2%. And I think we're going to see some further increase in long-term treasury yields. And in fact, since March 31st, some of that has already happened. We're already close to 5%. So I don't think of great value in long-term bonds. I think from here, they won't be as painful as they've been. But I still think that stocks are a somewhat better place to be. Another wild card, crude oil prices. Obviously, that reflects some of the turmoil around the world. And with that, Nico, if you have any questions, be happy to respond to them.
Yeah, Chuck, you mentioned about duration of bonds and uncertainty with the long term still with getting close to 5. What's your stance for clients that are in money market right now or short-term U.S. Treasuries for reserves if it's not part of their fully invested investment portfolio. What's your position on when do they get out of short-term money markets? Because you are getting over 5% right now, so it's good for the moment. But what's that balance? Any advice there?
Yeah, so I don't think there's any urgency to get out because I don't think the Fed's likely to cut rates in the near future. But the further you're out you go, the greater the probability that they will cut rates. They do want to cut rates, and if inflation comes down, they will. But I just don't see that near term. I don't see that right now in 2024. So I don't see any harm to staying in money markets, but at some point it'll make sense to buy shorter term intermediates. So something in the 3 to 6 year range. You're getting a little bit less interest, but you are getting some upside potential if and when rates do come down. And you can't get hurt too much even if rates rise because those bonds mature before too long.
Exactly. And then just question, we talked about oil and some level of geopolitical risk. What is the biggest concern or concerns that you would characterize that we need to be on outlook for long-term investors?
So I still see energy demand for fossil fuels rising, certainly for natural gas and even for crude oil. But the price of crude, and especially, but also the price of natural gas tends to be pretty volatile, depending upon all kinds of geopolitical events. If Iran and Saudi Arabia ever go to war with one another, you're going to see oil prices spike overnight. But at the same time, if they don't, if things calm down, then one of the risks that's definitely out there is that we are producing more and more in the US. We're increasingly supplying countries overseas, and we're cutting into the capacity of OPEC to sell oil because they've set an artificially high price. And if they ever start worrying that they're going to lose too much revenue, they could do again what they did back in 2015, where the Saudis said, that's it, we're out, and start pumping a lot more oil and driving the price down. And that's why I prefer to stay in the so-called midstream space, not upstream. Upstream is riskier. Midstream is a lot safer, and you can generate a lot of income because pipelines still need to carry the oil.
Yep, exactly right. And a potentially new trend we touched on briefly, but artificial intelligence. Are you seeing that being more prominent, or is that just a trend or something we should ignore in the headlines? How do you foresee artificial intelligence impacting the stock market? And just the success of companies across the country, really, our global economy.
Yeah, no, it is not a short-term story. It's a long-term story. And, there's an element here, not unlike the California gold rush. So there were a lot of people who went out looking for gold, and some of them found it, did very, very well, and most of them didn't. And in the case of artificial intelligence, there are the hardware manufacturers, and some of them have found gold, like NVIDIA, far ahead of everybody else. Everyone else is trying to catch up and produce chips that will compete. And it's a safe bet that some of them will succeed. But there are all kinds of other ways that artificial intelligence is going to be helpful to the economy. It'll create lots of ways to cut costs, to provide more service, better manufacturing. And those secondary ways are a safer way to play it. Yeah. So it's not unlike, again, the gold rush. You might be better off selling picks and shovels instead of going out to the field looking for gold. So if you can find the Levi Strauss that provides the jeans for the people looking out, digging for gold, that's a safer way to play it. And there are a lot of companies that will benefit to one degree or another. So there are some that produce memory chips. There are some that produce other types of chips. They'll all benefit. And then there are companies that create the applications using those chips, whether it's cell phones or whatever. So we as a people and all of society will benefit enormously from this thing, and it will take many years to play out.
Well said, and we'll end on that note, Chuck. We sincerely appreciate your time and knowledge and our partnership between RWS and ACM, and look forward to covering another topic in the future.
Anytime, Nico. We appreciate it as well.
Thanks, Chuck. We'll see you soon.
Take care.